So everything I'd read with regards to Chinese debt, and we've discussed this before, it seems like it's high risk. But I've also read recently with those, or no, we spoke to Doomberg yesterday, and he said with the kind of 180 that China's done on COVID, might see them kind of roar out and actually perform well.
So I think there's a chance for that because I mean their equity prices are super cheap because it's kind of like nobody really trusts them anymore. Because Chinese policymakers can change their view at any time. You face delisting risk in much of the world. If they were to invade Taiwan or something like that, I mean, a lot of those could be zeroed out for foreign investors in a similar way that any holders of Russian stocks. You might have been holding a cheap, high quality company, but if you held it when Russia went into Ukraine, you just got zeroed out, even if the company's still profitable. And so there's all these risks around Chinese equities in that sense. The challenge with China has always been in their real estate market. That's where they, culturally they want to store a lot of value, very high population country, and then you have basically very, very high valuations on their real estate, and then a lot of debt attached to it, and then that actually also bleeds out to the rest of the world. So that contributes to why Australia has such high property prices. That contributes to why Canada has such high property prices. It kind of pushes out a lot of these Chinese buyers are saying, well, Chinese real estate's ridiculously priced, so we'll go buy in these potentially safer jurisdictions. It's expensive, but it's not any more expensive than China, and so they go out there and it pushes those valuations up. And the risk there. So on one hand, China is deliberately trying to deflate their real estate bubble, right? I mean, their president came out and said, real estate is for living in, not speculating on. So the idea of a Chinese person having say 5 apartments, a lot of them are empty, and they're just kind of hoping for appreciation. They're trying to pull that kind of strategy in. But that, of course, comes with all sorts of downsides. That's basically slower construction activity, slower economic activity. People are not happy with their real estate holdings going down in price. And so you have kind of a slow, controlled demolition that's happening there that they can only maintain for so long, in my view. And so I do think that the reopening is kind of part of their realization that they're kind of pushing things pretty tight here. In terms of both the the debt load as well as public sentiment. So I'm somewhat less bearish on China than the average person, over kind of an intermediate term, because I do think that reopening could be pretty effective for them in that sense. I think the longer term risks for China are the one, they have pretty bad demographics. They basically they're one of the more top heavy populations when you look out over the next 10, 20, 30 years. And so that's going to be a challenge for them. And number 2 is that their geography has always just been challenging compared to, say, the United States, basically, compared to some of these other places, that they have certain limits to their geography that they've kind of been struggling with for a while. And so I'm an Asian financial crisis is not my base case, but it is something you have to keep watching, because with China, you never really know fully what the data is like, right? They selectively release data under President Xi. They've reduced their transparency, right? So for a number of decades, you had rising transparency, rising, at least somewhat market-oriented economy, and under President Xi, you've kind of reversed a lot of that. And so under that framework, it's hard to know for sure what you're looking at. You pretty much had to disregard things like COVID statistics. You had to disregard certain growth metrics. But there are still some out there, but you have to kind of take them with a grain of salt. So I'm less bearish on China than the average bear, let's say. And we also have to look at how that's going to impact the global economy, because one of the things holding energy down was Chinese lockdowns, that they were consuming less energy than they otherwise would or could have, right? So yeah, if you look at Chinese jet flights way down, construction activity down, and to the extent that either goes back up to 2019 levels or exceeds them, that's something coming back to the market and saying we're going to take an extra 1 million barrels a day, 2 million barrels a day of oil, whatever the numbers end up being, and that can put pressure on a tight energy market globally.
What about the supply chains? I know before you've tracked historical prices for containers and the kind of the shipping costs around the world, and we saw that. I think you and I discussed that when during the COVID lockdowns there was a massive increase in costs. Is there anything that you're seeing that's going to reduce the cost pressures of people who maybe in places like the UK or the US who are importing goods? Is there anything you're seeing there?
Well, there has been a significant disinflation this year of a lot of those shipping prices, and a lot of it was demand curtailment, right? So as prices got very high, and as you started to get stimulus being cut off, and as you started to get tighter monetary conditions, it kind of put pressure on the buyers, and that allowed those markets to somewhat more normalize. Um, the concern I have is that I think that a lot of people are kind of looking, it's kind of like a false sense of security, right? So some of those extreme moves were always going to come off, right? Those extreme levels don't just stay there. Eventually they do, high prices are the cure for high prices is the old saying. And so that's played out. I think the longer term thing is the fact that, we had multiple decades of globalization. So basically, you had a pool of capital, and then you had a number of pools of labor. Let's say China, former Soviet states, that kind of thing. And the last 3 to 4 decades are basically about tying those two things together, saying, okay, we have capital, you have labor. Let's build factories there. Let's build XYZ there, and then ship it. Let's build infrastructure. And now, in a less trustworthy world, in a more multipolar world, we're seeing kind of either a reversal of that trend, or at least like a slowdown and a stoppage of that trend. And that means that more of the cost pressures get pushed back on their own markets. And so I think we're in kind of a more structurally problematic environment for supply chains, where for decades you could ignore resiliency and focus on efficiency because the world was just always getting more and more unified and safer. And now when you can't rely on that fact, when you have to assume what if XYZ happens? What if this country invades that? What if relations between these two countries break down? What happens to my supply chain? You have to bake in more resiliency, and that comes at a cost. And so I think that the longer term story is that we're probably in a more a somewhat more inflationary environment in that regard, but the extreme edges are taken off because there's not that huge burst. Another thing about COVID is that it, in addition to the stimulus and things like that, it also rapidly changed people's behavior in a short period of time, which supply chains are not good at dealing with. So, like for a while, everybody stopped flying, and instead they started buying electronics and remodeling their home, right? And so that kind of activity just rapidly changes what people need, and that puts a lot of pressure on those areas. And then there's kind of been a kickback where they say, okay, now we remodeled our home. We're not going to remodel our home for 5 years. We want to go on a lot of flights now, right? And so you have almost like a pullback, and so you have disinflation in some of those goods that were inflated to begin with, and now you have plenty of activity in flying and hotels and things like that. And so I think that as that normalizes, we kind of come back down, but these longer term trends are probably still here.
Well, we've seen that with our travel, right, Danny? I mean, when COVID kind of ended and we first started traveling, we were able to get flights ridiculously cheap. Like Danny was flying business from Australia because it was so damn cheap. And over the last, I would say, 12 months, Danny, would you say they've doubled in price?
At least doubled. I think my last flight to the US was double what a business flight used to cost.
Yes, like our travel costs have essentially doubled in the space of a year. Also, we've noticed like our Airbnb costs, because you know what our setup is. The Airbnb costs have gone up massively. There's a place we rented previously where they essentially doubled the price, and I can't tell if that's. It feels a bit like what you said, that the supply dropped and now there's a massive increase in demand, but the supply hasn't come back.
Yeah, so for flights, for example, the supply is not fully back. And it also just ties into the whole rotation I just discussed, where, around the margins, if more people want to do one thing at the same time, let's say buy goods or refurbish their home, that's going to put a lot of pressure there. And everyone says, okay, we did that the last few years. Now we're all going to travel. We're all going to, do things we couldn't do for the past few years, and start ramping up in that regard. There's less international restrictions on travel, which persisted, pretty long in many cases. I mean, back in earlier this year, there were still tons of restrictions that have kind of eased throughout this year. And so as those have eased, basically there's just more and more people that are flooding into travel and things like that, while supply, at least for flights and things like that, is still not fully ramped up. And so I think we're going to see probably a similar phenomenon where when we look back, let's say a year from now, 2 years from now, it's hard to say exactly how long it goes, but I think some of these extreme prices will cool off to some extent, because you either get supply coming back online, or those high prices will then deter some people that said, okay, we got some travel out of our system. This is getting really expensive. Let's stay home this year. and then the market can normalize. But
Mm.
then I think, longer term, the question becomes energy security and gradual deglobalization. Those are, I think, the longer term inflationary drivers, where some of these were shorter term.
So do you think these are actual trends that come in this kind of deglobalization?
I think in rate of change terms, yes.
Yeah.
So when people hear deglobalization, I mean, it depends on what you mean by that, because it could mean that, in the extreme sense, like let's say U.S. and China don't trade anymore. Is that going to come anytime soon? No. But I think it essentially means that you've tapped out a lot of the kind of the easy adjustments, right? Or we've already picked the low hanging fruit of globalization, which was essentially, going into the 80s, let's say, China was very impoverished and opened up to the world. So that was like, okay, here's hundreds of millions of workers, and then there's large pools of capital that said, okay, let's join that. And then you had the fall of the Soviet Union in the early 90s, so you had a number of states there able to open up, and so you had this like basically this huge environment that was just ready to come together. And I think a lot of that's already been done, and then now we see Russia separating, China kind of closing off, more tensions, more kind of tail risks being realized. It's like, what if China does do something with Taiwan? What does that mean for all the U.S. companies and infrastructure there? Does that mean that the U.S. freezes Chinese assets, right? So do they want to hold their assets in the United States the way that they used to? You also have, for example, all the way back in 2013, China announced, when they announced their Belt and Road Initiative, they announced that it's no longer in their best interest to keep accumulating treasuries. So it's not like on day one they just sold all their treasuries, but what they essentially did was they hit a high watermark for how many treasuries they want to hold, and then they're just like flat to down, even though they're still running giant trade surpluses in dollars, and they're just funneling those dollars to other things, which is essentially loans to African countries, South American countries, Southeast Asian countries, all sorts of different projects. And so I do think we see a more multipolar world, and that the low-hanging fruit of globalization is behind us, but it doesn't mean that we backtrack on all of our gains right away. It just means, especially for national security industries, like let's say semiconductors, certain energy things, there's kind of a realignment and kind of a renewed interest in resiliency and kind of backups.